there, it's Friday the 28th of September 2018. I'm Steve Towers. Welcome to International Tax Bites, ITB, my weekly review of the important international tax developments impacting multinationals. This week I have these stories for you. It's just over 3 months since the US Supreme Court delivered its landmark decision in the Wayfair case. Let's take stock of the reaction so far. Let's start with a quick reminder of the case. The appellant is the South Dakota state government. The respondents are 3 unrelated US e-commerce companies, or as described by the court, 3 leading or major online retailers of goods such as home furniture, clothing, and consumer electronics. Justice Kennedy, who gave the leading majority judgment, said this: "The 3 respondents are merchants with no employees or real estate in South Dakota. Each of these 3 companies ships its goods directly to purchasers throughout the United States, including South Dakota." South Dakota in 2016 enacted legislation which requires out-of-state sellers to collect and remit South Dakota sales tax as if the seller had a physical presence in the state. However, the legislation has an important threshold requirement. It only applies to sellers which, on an annual basis, either deliver more than $100,000 of goods or services into the state, or engage in 200 or more separate transactions for the delivery of goods or services into the state. The 3 respondents challenged the validity of this legislation on the basis that it breaches the Commerce Clause in the US Constitution. Under Supreme Court case law, the Complete Auto case, a state tax will not breach the Commerce Clause if it satisfies all of 4 conditions. First, it applies to an activity with a substantial nexus with the taxing state. Second, it is fairly apportioned. Third, it does not discriminate against interstate commerce. And fourth, it is fairly related to the services the state provides. Critically, in regard to the first of these 4 conditions, 2 US Supreme Court cases, Bellis Hess and Quill, held that a substantial nexus requires the seller to maintain a physical presence, such as retail outlets, solicitors, or property within a state. For obvious reasons, the court called this the physical presence test. In the Wayfair case, the 3 respondents argued that the 2016 South Dakota legislation does not require a physical presence in the state, and thus it does not satisfy the substantial nexus condition. In the Supreme Court in Wayfair, the majority overruled the Bellis, Hess and Quill cases and held that the physical presence test does not apply to the substantial nexus condition. I won't go into the detailed reasons the majority gave for invalidating the physical presence test. Suffice to say that the majority decided that such a test was unsuited for commerce in the 21st century, and it also facilitated tax avoidance and indeed evasion. There's also an interesting issue about stare decisis, the rule of precedent, and whether it was appropriate for the court in this case to overrule 2 of its previous decisions. Folks are now writing articles on that topic. I won't go into that issue either. But let's go back to the South Dakota legislation. Having rejected the physical presence test, The majority then addressed whether the substantial nexus condition was satisfied by the South Dakota legislation. Justice Kennedy said this: "In the absence of Quill and Bellis Hess, the first condition of the complete auto case simply asks whether the tax applies to an activity with a substantial nexus with the taxing state. Such a nexus is established when the taxpayer or collector avails itself of the substantial privilege of carrying on business in that jurisdiction. Here, the nexus is clearly sufficient based on both the economic and virtual contacts respondents have with the state. The Act applies only to sellers that deliver more than $100,000 of goods or services into South Dakota or engage in 200 or more separate transactions for the delivery of goods or services into the state on an annual basis. This quantity of business could not have occurred unless the seller availed itself of the substantial privilege of carrying on business in South Dakota. And respondents are large national companies that undoubtedly maintain an extensive virtual presence. Thus, the substantial nexus requirement of complete auto is satisfied in this case." You'll notice that in this second paragraph, Justice Kennedy looks firstly to the economic threshold levels which are set out in the Act, and then he looks at the size of the three respondents and their virtual presence in the state. So his conclusion on the substantial nexus condition seems to be based on both of two factors: the economic threshold conditions in the legislation and the size of the particular taxpayers and their virtual presence in the state. As we go through the reactions of various states to this Wayfair decision, the economic threshold levels of $100,000 or 200 separate transactions will become very familiar. Don't worry, I'm not going to take you through all 50 states. Instead, I'll focus on a selection of the big states, and then only on those where there's been some substantive reaction to the Wayfair case. And let me say at the outset that many of the states have copied the South Dakota tests, but not all, and sometimes there are subtle differences. Let's start with California. Draft legislation was prepared by the state government, requiring both remote sellers and marketplace facilitators to collect sales and use tax if the annual sales into the state were $500,000 or more. However, it's been reported that the legislation died with the ending of the legislative session on the 31st of August. Colorado has issued an emergency regulation which will require remote sellers to collect sales tax on sales made to Colorado purchasers if the economic annual threshold is satisfied. More than $100,000 of Colorado sales of tangible personal property or services, or 200 or more separate transactions for Colorado sales of tangible personal property or services. The regulation applies from the 1st of December. Now to Illinois. An emergency regulation has been issued requiring remote sellers to register with the Department of Revenue to collect and remit use tax if the economic annual threshold is satisfied. $100,000 or more in Illinois sales of tangible personal property, or 200 or more separate transactions for Illinois sales of tangible personal property. The regulation is effective on the 1st of October, in other words, next Monday. The determination of whether the annual threshold has been satisfied is to be done at the end of each calendar quarter for the preceding 12-month period. In Maryland, an emergency regulation will require remote sellers to collect and remit sales and use tax on sales to Maryland purchasers if the economic annual threshold is satisfied. More than $100,000 of Maryland sales of tangible personal property or taxable services, or 200 or more separate transactions for Maryland sales of tangible personal property or taxable services. This requirement is effective on the 1st of October, next Monday. In Massachusetts, the tax authorities have advised that the state's existing sales and use tax law, which relevantly took effect in October 2017, was not impacted by the Wayfair decision. It already applies to remote sellers which have certain internet connections with Massachusetts, such as cookies or apps in the state, if the economic annual threshold is satisfied. More than $500,000 in Massachusetts sales and, please note that I said and, 100 or more separate transactions for Massachusetts sales. In Michigan, the tax authorities have stated that remote sellers must collect and remit sales tax on sales to Michigan purchasers if the economic annual threshold is satisfied. More than $100,000 of Michigan sales or 200 or more separate transactions for Michigan sales. These rules apply from the 1st of October, next Monday. In Minnesota, the tax authorities have stated that remote sellers which are ineligible for the state's small seller exception are required to register to collect and remit sales tax by the 1st of October, again next Monday. A seller is ineligible for the small seller exception if the economic annual threshold is satisfied. More than $100,000 of Minnesota sales of goods or services from 10 or more transactions, or 100 or more separate transactions for Minnesota sales of goods or services. In addition, marketplace operators are required to register and start collecting tax on behalf of remote sellers by the 1st of October. In New Jersey, the tax authorities have stated that effective on the 1st of October, next Monday, remote sellers must register, collect and remit sales tax on sales to New Jersey purchasers if the economic annual threshold is satisfied. More than $100,000 in sales of tangible personal property, specified digital products or services into New Jersey, or 200 or more separate transactions for the sale of tangible personal property, specified digital products or services into New Jersey. In North Carolina, the tax authorities have stated that remote sellers must register to collect and remit sales and use tax on sales to North Carolina purchasers if the economic annual threshold is satisfied. More than $100,000 of North Carolina sales or 200 or more separate transactions for North Carolina sales. This requirement is effective the 1st of November. In Tennessee, the tax authorities have stated that remote sellers are not required to collect and remit sales and use tax pending a review of the Wayfair decision by the state legislature. Also, if such a requirement does commence, there will be no retrospective application. In Texas, a proposed regulation has been prepared for review and feedback by 2 advisory committees. Under the proposed regulation, remote sellers would qualify for a safe harbour if their annual gross revenue from the sale of tangible personal property and services for storage, use, or other consumption in Texas is less than $500,000. In Washington state, the tax authorities have stated that remote sellers and marketplace facilitators are required to collect and remit sales and use tax on sales to Washington purchasers if the economic annual threshold is satisfied, more than $100,000 in Washington sales or 200 or more separate transactions for Washington sales. This requirement is effective the 1st of October, again next Monday. For remote sellers and marketplace facilitators which don't satisfy that threshold, but which do have more than $10,000 in annual Washington sales, there is an existing obligation to collect or report. And in Wisconsin, the government has issued administrative rules which require remote sellers to collect and remit sales tax on sales to Wisconsin purchasers if the economic annual threshold is satisfied, more than $100,000 in Wisconsin sales or 200 or more separate transactions for Wisconsin sales. Enforcement of these rules will commence on the 1st of October, next Monday. Quite a number of the smaller states have also made substantive reactions to the Wayfair decision. But so far, there has been no substantive reaction to the Wayfair decision from Florida, Missouri, apologies to those who use a different pronunciation, New York, Ohio, Pennsylvania, or Virginia. However, even before the Wayfair decision, some of these states already had economic nexus rules which applied to remote sellers. At the federal level, there is some appetite for legislation to regulate the way states can react to the Wayfair decision. A bill was introduced by a bipartisan group of US House members last week to do just that. The Online Sales Simplicity and Small Business Relief Act is designed to address a number of concerns from the Wayfair decision. It will prohibit states from a retrospective application of the Wayfair decision. In other words, no application to remote sales before the 21st of June 2018, the date of the Supreme Court decision. It will prohibit states from implementing new collection requirements on remote sellers before the 1st of January 2019. And it will provide for a temporary small business exemption for remote sellers with less than $10 million in US gross annual receipts. The National Council of State Legislatures is not impressed. The bill is an unwarranted intrusion on state authority, which, if enacted, would continue the competitive advantage online sellers enjoy over Main Street sellers. An interesting issue which has been identified is the impact of the Wayfair decision on state income or other taxes, which are subject to the same substantial nexus condition under the Commerce Clause as sales and use taxes. Some states already use factor-based and/or economic nexus rules for income or gross receipts taxes. The open question is whether the Wayfair decision will entice other states to follow suit. This issue is complicated by the fact that there is existing federal legislation, PL 86-272, which prohibits a state from imposing an income tax on an out-of-state company in certain situations. Today might be particularly busy in Paris. Sunday, the 30th of September, is an important cut-off date for the MLI, the BEPS Multilateral Convention. The OECD's website indicates that as of yesterday, the 27th of September, 15 jurisdictions had deposited their instruments of ratification, acceptance or approval with the OECD. Australia, Austria, France, Isle of Man, Israel, Japan, Jersey, Lithuania, New Zealand, Poland, Serbia, Slovak Republic, Slovenia, Sweden and the UK, with 3 of them having done so this week. But folks are expecting a few more jurisdictions to do so by the 30th of September. This is to ensure that the MLI operates in 2019 in regard to withholding tax, particularly in regard to the PPT, the Principal Purpose Test. And that is because of the combined operation of Articles 34 and 35 of the MLI. Article 34.2 says this: for each signatory ratifying, accepting or approving this convention after the deposit of the 5th instrument of ratification, acceptance or approval, the convention shall enter into force on the first day of the month following the expiration of a period of 3 calendar months, beginning on the date of the deposit by such signatory of its instrument of ratification, acceptance or approval. So, this means that if a jurisdiction which is a signatory to the MLI deposits its instrument of ratification, acceptance or approval by the 30th of September, the MLI will enter into force for that jurisdiction on the 1st of January 2019. Article 35.1 says this: the provisions of this convention shall have effect in each contracting jurisdiction with respect to a covered tax agreement, A, with respect to taxes withheld at source on amounts paid or credited to non-residents, where the event giving rise to such taxes occurs on or after the first day of the next calendar year that begins on or after the latest of the dates on which this convention enters into force for each of the contracting jurisdictions to the covered tax agreement. Let's assume that both parties to a bilateral double tax treaty have signed the MLI and deposit their instruments of ratification, etc., during the month of September 2018. Paragraph A refers to the latest of the dates on which this convention enters into force for each of the contracting jurisdictions to the covered tax agreement. That would be the 1st of January 2019. Paragraph A also identifies the first day of the next calendar year that begins on or after the 1st of January 2019. And that day, of course, is the 1st of January 2019. So the MLI would apply to withholding tax where the event giving rise to that tax occurs on or after the 1st of January 2019. And what would be the start date if both treaty parties deposit the instruments of ratification, etc., in October 2018? Under Article 34.2, the MLI would enter into force for each of the 2 jurisdictions on the 1st of February 2019. And under Article 35.1a, the MLI would have effect with respect to withholding tax where the event giving rise to that tax occurs on or after the 1st of January 2020. Now, it is true that a jurisdiction can use Article 35.2, which says this: solely for the purpose of its own application of Article 35.1a, a party may choose to substitute taxable period for calendar year and shall notify the depository accordingly. But for most countries, the taxable period is the calendar year, so in those cases, that would not achieve anything. And now for the developments in Asia Pacific. In Australia, the tax authorities have released the final version of guidance on the DPT, the Diverted Profits Tax. The guidance consists of a law companion ruling and a practical compliance guideline. There was public consultation on earlier drafts of these two documents in February and March this year. There have been no fundamental changes to the two documents. An interesting aspect of the practical compliance guideline is the series of examples of high-risk and low-risk situations for the sufficient economic substance test under the DPT. For a copy of these two documents, please go to our website or app. Also in Australia, a long list of amendment bills have been introduced into Parliament. These bills deal with a number of policy announcements which were made in this year's budget or at other times. There's no new topics. Topics covered include changes to the thin cap rules, changes to the R&D tax incentive, and new rules for stapled structures. The most interesting aspect of all of this proposed legislation is the name of one of the bills, Treasury Laws Amendment, making sure foreign investors pay their fair share of tax in Australia, and other measures, Bill 2018. Can you devise an acronym? In China, the government has issued a Circular 99 of 2018, which increases the tax incentive for R&D activities. For R&D expenditure incurred in the period from the 1st of January 2018 to the 31st of December 2020, the extra deduction will be 75%. In other words, a total deduction of 175% of the expenditure, provided the R&D has not yet resulted in an intangible. However, if it has resulted in an intangible, then an extra 75% of the relevant R&D expenditure incurred during that same period will be added to the cost base of the intangible for amortization purposes. Again, a total of 175% will be included in the cost base. For a copy of Circular 99, please go to our website or app. In India, the Chandigarh Income Tax Appellate Tribunal has decided a case concerning the interest article in the India-UK Double Tax Treaty. The taxpayer, a UK resident, wanted to invest in a proposed real estate project in India. For that purpose, the taxpayer made an advance payment equal to 95% of the sale price to the Indian developer. On the advance payment, the developer was required to pay what was called an assured return on a monthly basis until the real estate development was completed and the taxpayer obtained possession of the property. The assured return was the same fixed amount each month. Importantly, under the relevant contract, the taxpayer did not have any property interest in the real estate until possession was given to him. The issue in the case was whether the monthly assured return was or was not interest under the treaty. The definition of interest in the treaty follows the OECD model, income from debt claims of every kind. The tribunal held that the advance payment was a debt owed by the developer to the taxpayer. Key to this view was the fact that the taxpayer did not have a property interest in the real estate prior to taking possession. and therefore the assured return satisfied the definition of interest in the treaty, and accordingly the interest article applied to the assured return. Also in India, next Monday, the 1st of October, is the start of the GST collection obligations which have been placed on e-commerce marketplace operators. The operators will be required to collect a 1% TCS, tax collected at source, from funds derived by vendors which sell via their platforms. This is a compliance initiative. The TCS tax will be creditable against the vendor's ultimate liability for GST. The marketplace operators are not happy with the initiative. Firstly, for being required to be unpaid tax collectors, and secondly, the fact that only a few weeks' notice was given by the government. And in Korea, the big tax news this week is the signing of the revised Korea-US Free Trade Agreement, commonly known as KORUS. The original KORUS was signed in 2012. The new version removes some Korean regulatory barriers to imports of US motor vehicle parts. It effectively doubles the number of US cars which can be imported into Korea, and it extends by 20 years a US 25% tariff on imported Korean trucks. Also under the new agreement, the US has agreed to exempt Korea from the new 25% tariff on steel. Instead, Korea accepted a quota to limit steel exports to the US. If you would like to obtain a copy of the US Trade Representative's fact sheet on the new KORUS, please go to our website or app. And now for the developments in Europe. In Austria, the government has released updated guidance in regard to tax issues concerning reorganisations. For a copy of the guidance, please go to our website or app. In Denmark, the tax authorities have released a redacted private ruling in regard to the PE definition under the Denmark-Switzerland Treaty. The question was whether a Danish representative's home office qualified as an Article 5.1 PE. On the facts presented, the ruling says yes, there is a PE. The important issue was whether the representative's activities satisfied the preparatory or auxiliary exceptions in Article 5. The ruling says that they do not. For a copy of this ruling, please go to our website or app. The European Court of Justice has decided a case which concerns the imposition of an interest penalty when there is no underlying tax debt. The case originates in Bulgaria. A Bulgarian company leased equipment from several unrelated non-resident companies, which were resident in various treaty countries, all being EU member states. The lease payments were exempted from withholding tax under those treaties. The Bulgarian company therefore did not withhold any tax from the lease payments. However, it took the Bulgarian company up to 4 years to obtain all of the documentation which showed that the non-resident companies qualified for the treaty exemptions. Due to that delay, the Bulgarian tax authorities levied an interest penalty on the Bulgarian company, calculated on the amount of withholding tax which is applicable under domestic law. And that interest penalty was irrecoverable, even though the Bulgarian company, after 4 years, had shown that there was no underlying withholding tax liability. Under Bulgarian law, the interest penalty would not apply if the lease payments were made to another Bulgarian company. The court therefore held that the imposition of the interest penalty constituted a breach of the EU freedom to provide services, the leasing services. And it also held that that breach could not be justified on the basis of ensuring compliance due to the fact that the interest penalty was irrecoverable, even though the underlying withholding tax liability was nil. For a copy of this decision, please go to our website or app. The European General Court has decided a case concerning whether the Danish government incentives given to the operators of the fixed link bridge between Denmark and Sweden are illegal state aid. In 2014, the European Commission effectively approved the Danish government incentives under Article 107.3 of the EU Treaty, on the basis that the bridge was an important project of common European interest. The General Court has now ruled that the Commission failed to thoroughly investigate and assess the relevant issues. It has therefore annulled the Commission's 2014 decision. For a copy of this decision, please go to our website or app. In the EU, the European Commission has released a report on the EU's VAT gap, the overall difference between the expected VAT revenue and the amount actually collected. In 2016, the VAT gap amounted to 147.1 billion euros. Across the EU, this equates to a total revenue loss of 12.3%. But in some member states, the percentage is much higher. First prize, if that's the right term, goes to Romania, which loses just over 35% of its VAT revenue. The report identifies four main causes of the VAT gap: fraud and tax evasion, corporate insolvency and bankruptcy, maladministration, and legal tax optimization. For a copy of the report, please go to our website or app. And the EU has received criticism in two reports which have been released. The first report focuses on double tax treaties between EU member states and developing countries. It concludes that many of these treaties unfairly restrict the developing countries' source taxing rights. The report was prepared by Martin Heersen from LSE. The second report criticises the EU's tax haven blacklist, not the existence of the list, but the names which are not on the list. According to the report, the blacklist fails to include any of the top 10 suppliers of financial secrecy services to the EU. The report was prepared by the Tax Justice Network. For a copy of these two reports, please go to our website or app. In France, the government has presented its 2019 budget and draft finance bill. From the viewpoint of multinationals, here are the items which caught my eye. The finance bill will implement the EU's ATAD 1. In particular, it will include the net interest expense limitation derived from BEPS Action 4, effective from the 1st of January 2019. Under the draft bill, the limitation is set at 30% of EBITDA, but with a threshold of 3 million euros. In other words, net interest expense which does not exceed 3 million euros is deductible regardless of the 30% test. But even if the 30% test does apply, there's a potential safe harbour using an equity to asset ratio. However, the 30% 3 million euros limits are reduced to 10% and 1 million euros if the company is considered to be thinly capitalised. Excess interest can be carried forward indefinitely. There are no grandfathering rules and no specific exceptions for financial institutions. And the bill will abolish several existing interest limitation rules. The bill also implements the anti-abuse rule from ATAD 1. The bill will amend the existing patent box incentive to make it compliant with BEPS Action 5. And the scheduled reduction in corporate income tax rates will continue in 2019. For that year, the rate will be 28% on taxable income up to €500,000 and then 31% above that amount. In the Netherlands, the government has launched an internet-based public consultation in regard to two international tax issues: proposed amendments to the Dutch double tax treaty policy and development of a list of low-tax jurisdictions to be used initially as part of the new CFC rules. The consultation will run to the 22nd of October. And now to the UK, where the government has effectively been given a €3 billion invoice by the European Commission in regard to uncollected customs duties. The matter relates to a customs duty fraud relating to imports into the UK of textiles and footwear from China. The assertion is that the UK failed to take effective action to prevent the fraud. After initiating a formal infringement procedure in March this year, the European Commission has now sent a reasoned opinion to the UK. The Commission's next step might be to refer the matter to the European Court of Justice. For a copy of the Commission's press release, please go to our website or app. And now to Africa. In Benin, the government has decided to cancel a proposed social media tax after significant public protests. The cancellation was announced just 3 days after the new tax became effective. The social media tax would have taxed the use of services such as Facebook, WhatsApp, and Twitter. Benin is the latest African country to propose a tax on internet use. Uganda imposed a social media tax from July this year. And in Zambia, the government announced in August a tax on internet calls. The objectives of these taxes are a little unclear. Governments have pointed to revenue-raising objectives or to protect domestic competitors. However, some folks have suggested that there's also a desire to reduce the use of platforms which have been used for public criticism of the government. In Nigeria, there's been another VAT case in which the court has applied the destination principle in regard to inbound services, even though the VAT legislation does not expressly provide for it. The recent case is called Gazprom Oil and Gas. It's a decision of the Federal High Court. The Nigerian company paid for services which were performed totally outside Nigeria by non-resident companies with no operations in Nigeria. The court held that the foreign companies were required to register for VAT and charge VAT on their services. As they had not done so, the court ruled that the Nigerian company was required to pay the VAT on a reverse charge basis. And that caused a tax cost for the Nigerian company because the VAT law does not allow an input tax credit for VAT on such services. This recent Gazprom case follows a similar decision by the Federal High Court in the Vodacom case in 2017. If you would like to obtain a copy of the Gazprom decision, please go to our website or app. And now for the developments in the Americas. In the US, the long-awaited proposed regulations which will remove the documentation requirements from the Section 385 regs have finally been released. For your copy, please go to our website or app. Also in the US, the IRS has issued Notice 2018-72, which delays for a further 2 years the dividend equivalent regulations under Section 871M. For a copy of this notice, please go to our website or app. Now, I don't want to give you guys the wrong idea, but some folks are making a lot of money in the US from tax whistleblowing. This week, there's news of a whistleblower who was awarded $13.6 million by the IRS for his or her, the identity is anonymous, work. The whistleblower's lawyers have issued a press release. For your copy, please go to our website or app. Well, that's the way it is this Friday, the 28th of September 2018. I'm Steve Towers. Have a great weekend. So when President Trump and President Moon signed the new free trade agreement, do you think there was a chorus of approval?